Hey, I'm Abe, and today we're going to learn about dollar cost averaging, why it's important, and why you should consider using it when doing your investing. And through the course of this and the many investing videos to come, please jump into the comments. Let me know what questions you have. If I use a term or refer to something that you don't understand, by all means, let me know, and I will either make a video specifically for that topic or I will answer you in the comments and we can have a little discussion. So let's jump right into it. Dollar cost averaging, or as it's also known, the constant dollar plan, is taking a large lump sum of money and instead of investing it all in one go, parsing it out and investing it at a regular scheduled period of time over a long period of time. So instead of taking $1,200 and investing it once a year, you're taking $100 every month and you're investing it that month. And you're not worrying about where the market is at. You're not worrying about whether it's high or low and whether now is a good time to invest or not. You're just being very methodical. You're putting your money in and you're letting it ride, which is what long-term investment strategy is all about, is picking, once you've developed your strategy, you need to trust that and just ride that strategy all the way to the end. And one of the key tenets of that strategy will be, or should be perhaps, dollar cost averaging. You'll see it in your 401k investments when your company, if you are lucky enough to have a company that offers 401k, that it's pulling money out of your paycheck every 2 weeks, every month, and it's putting it in. That is dollar cost averaging. So you may, at least in part, already be doing it to some extent. The goals of dollar cost averaging are to remove the emotion of investing. So instead of getting stressed and seeing the market go up or down and feeling like you need to act somehow, that you need to take your money and put it in or take your money and pull it out or whatever, that it takes the emotion and the stress out of it. And it also drives home the point that you can't and should not try to time the market. A lot of people fall into this trap of trying to buy low, sell high. It's the common theory that everyone is aware of, but in doing so, they often end up buying high and selling low, acting on emotions. And that's the second thing that dollar cost averaging does for you, is it removes the emotion from the equation. Let's take a look at an example. I pulled these specifically from the market performance over the last 2 years, and we can look at the difference between looking at $1,200 once a year to $100 a month and see what the differences are there. Two examples. One would be the batch investing that we've talked about. You take the entire year, and like we've talked about in previous videos, you're saving $100 a month to a yearly total of $1,200. And then at the end of that year, you're thinking, okay, I've saved this amount of money. I plan to invest it. And right around tax time, I see where I fall. I see that I do have this $1,200 and I can use it. And I invested. This is the theory. And so you're looking back and you're saying, all right, for May, June, all the way through April of 2019, I was able to save $100 each. And then I took that $1,200 and I invested it in the S&P ETF, which is an exchange traded fund. It is the market, basically. It's your way of investing in the market. So I've invested in SPY I took $1,200. I bought what looks like 4.08 shares of this fund. And now I'm going to hold it for the year, and then at the end of the next year, I'm going to buy another $1,200. I've mapped the change here from month to month in the stock. And so if you look at that, you can also sort of see how emotionally you would feel as you saved your money and waited to invest. That as the highs came, you might be thinking that you should have been in earlier. As the lows came, you might be afraid that your money is going to would lose value, and so you would want to take it out. And then at the end of this year, you finally put your money in and you're thinking, okay, I finally did it. Now let's see how it goes. And the first month after you've invested, it drops almost 7%. It's crushing. So now you've lost $80, right? And this is the profit. This column over here, this is just on your investment of $1,200. This is where you're at net. So you've lost $76 overall. Now it's only $4 because the market came back a bit. Now you're up. Now you're up a bunch as you go through. And then there was a bad, obviously in the March of 2020, there was a really big drop in the market. And so you can see you lost all of your earnings right there. And then after 2 years, you've invested $2,400. You own 8.21 shares. And it is totally valued at $23.85. The roller coaster ride that you went on here over these 2 years is immense. I mean, some months it's up 7%, some months it's down 10, 15%. It's all over the place. And this sort of thing can really stress you out as an investor. So this is what happens if you just take your money and you invest it at one point and let it ride in that way. Now, if you think about this over the course of 50 years, if you're doing this every year, once a year, and you're taking this, essentially that's kind of what you're doing. You are using dollar cost averaging. But to further smooth out the wrinkles in your plan, maybe you should look at something more frequent, whether it's once a week, once a month, whatever it is, whatever makes sense for you and your budget. Follow that, follow your instincts, and also keep in mind that as you trade more frequently, that some of these brokerage sites or some of the brokerage locations will charge you per trade, $3, $7, whatever it ends up being. And the cost of that also will add up over time. So something to keep in mind. Let's go to the next example where we look at dollar cost averaging spread out a little bit more and see what the net effect is. We've got the same amount of money invested. It's just spread out $100 every month from May 2018, same period of time, to April 2020. We've got $100, and each month this $100 nets us a purchase of varying amounts of the stock, but a small quantity, right? And that's fine. It's the same amount. We're just spreading it out. And this could be part of your budget, right? Once you identify how much April netted you, you could take the amount that you plan to save and put it in the market. Just invest it on May 1st. And then on June 1st, do the same thing. July 1st, August 1st. And as you go, you'll see now, instead of being stressed out, you just set up a regular schedule, you have a cadence that you do it, and then you get out of the way. And you don't have to worry about whether the market is going up or down that particular month because you're taking advantage of both. That when the market is only up a little bit, you're buying some. When the market is down significantly, you're taking advantage of the gains when it comes back. So this $100 benefits from the 10, 15% that it came back over the next few months. And so this $100 is now making up for the money that you spent here when it was high and it lost a little bit of value. So it really smooths out the curve. Number of shares purchased, it varies a little bit, 0.369, 0.35, 0.344. We get varying amounts. And you can see that our profit now varies. And so at the end of the total amount of time, we actually own more shares than we did previously, and our money is actually worth more. And so the real value comes in being able to, without trying to time the market, without being emotional, take advantage of every aspect of the market. That as the market continues its slow climb over decades, that you're riding that greater line. You're not riding the big dips and the big highs and trying to act and be smarter than the market or smarter than other investors. You're just following your plan. You're very methodical, and you're taking advantage of every aspect of the market. The market goes down, you benefit from that. Your overall value, the dollar amount invested, may decrease a little bit, but the blow from having your invested amount decrease in value is lessened because you're actually buying while it's down. So you are doing the buy low portion of that without needing to worry about thinking about it. This is the difference between batch investing and dollar cost averaging. So this is a stress-free way to invest. You just pick a certain amount that at the end of your budget each month, you determine how much you're going to invest and you invest it. And you don't think about whether the market is up or down because your time horizon, and as we get into some of these investment videos further down the line, you'll understand that the time horizon is a critical part of determining what you should invest and how you should invest it. That if you're planning to make short-term gains, then this takes on this has a different meaning. Whereas if you're looking at 20 years, 30 years, 50 years down the line, then you really are just trying to ride that general increasing trend that the market follows and not stress out as things dip and ripple along the way. And this method, this dollar cost averaging method, will give you the patience, the peace of mind to do that successfully. Thank you for watching. Hit me up in the comments with what questions you have, and we'll get more into investing and savings and all kinds of terminology definitions as we move forward to build out this lexicon of knowledge. And that's all I've got for today. Thank you for watching, and I'll catch you in the next video.